Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 2nd, 2023. It is 10:39 a.m. Eastern Time as I'm starting the video, and what I'm going to do in this one is kind of follow up to yesterday's video. Now, on yesterday's video, what had happened, this has happened just a few times. I've noticed a glitch in the screen recording software. I apologize. I just saw this morning all the comments under yesterday's video. There was the previous one. Every now and then I'll record a video, you wrap up, and then it goes to the production. Once you stop recording, it goes to production anyways, and then there's a link to upload to YouTube. I click that. Every now and then it takes the video I just finished recording, it brings that in, and then for some reason it uploads the previous one. I have no way of knowing unless I were to watch the video afterwards or play it. If I can dig that one up, sometimes those, if I've shut down the computer and resets it, I don't know if it's there. I'll post it below. But I'm going to just recap that, and particularly the long-term analysis, because that's what I did in yesterday's video. Lately I've been hyper-focused on the short-term charts, talking about the benefits of active trading, how the market was likely to grind around. Well, bigger picture says that I think, bigger picture tells me that we're still in a bear market by just about every metric that I have, and that not only are we in a bear market, but there's probably another leg down to come, and that may come sooner than later. I think we're getting close to that time, and I'm starting to get a little more confident to maybe add back some swing trend short positions. I talk about active trading, I talk about wearing different hats and also providing analysis for different time frames, different traders or investors. There's 401k monies and other things. And so let me just start here with this, and I'm not going to go in depth as I did yesterday, but this is a long-term chart. This goes back into the 80s, the mid 80s on SPY, the S&P 500 tracking ETF, which has been around. That's one of the longer ETFs, been around in existence for a while. And it does a great job of tracking the S&P 500. You can use either chart, doesn't matter, because there's really hardly any slippage or decay here. And you can see the what this chart shows us, a lot of things here, but you have all the big corrections, or technically to me it's an antiquated measure of a bear market, a drop of 20% off the highs. In recent decades, there's so much heavy-handedness from the Fed to prop up and shore the equity markets and try to stave off recessions, and that excessive intervention has led to increased volatility. And to me, really a 20% drop, 25 is a correction, not a bear market. But go whatever, it's semantics, call it what you want. But the big bear markets are the only two, in my opinion, that we've had for decades now. Came after the dot-com bust. That was in March of 2000 where the markets peaked. They bottomed in 2002. It was a 51% drop. And then we had, of course, most of you might remember if you weren't around then, trading or investing or even around period. This one here from 2007 to 2000 and early '09 right there. That was the financial crisis, though. Call that or whatever we want to label it. And that was a roughly 57% drop. Even COVID, by the technical metric of a 20% drop, that was a bear market. And you can really say the fourth quarter 2018 and in this little flash crash back in 2011 and all those. But to me, these were the two bear markets. And then where I'm going with this is you have, I consider and still consider, from a secular perspective, a big trend that we're in a large secular bull market. I mean, that's really not up for debate. It's been a secular bull market really since back here in about the early 80s when interest rates peaked. And what I showed you is, and this helps to support my long-term views, treasury bonds. If you're not familiar with this, I can tell you it's an old rule that holds true. It's not it's simply that when interest rates are falling, that's bullish for equities for two reasons. Number one, lower interest rates equal a lower cost of capital to both individuals and businesses. So if Tesla or ABC company wants to open a brand new plant to build more widgets, or you want to buy a house, a boat, a plane, whatever it is, your money goes further, and you're more likely to do it when interest rates are low or falling. and uh, and of course, rising interest rates is constrictive to the economy. The higher rates go, especially the faster they go, that really puts the brakes on things. So, by every metric that I have, this is if I kind of just jumping into it, TYX is the 30-year Treasury bond yield, and that is by every single metric, it's been in a secular bear market since interest rates peaked back in the very early 80s. That's when Carter coming out of that office, out of the hyperinflationary environment, Reagan coming in, and that's how far back that goes. And you can see the clear trend in rates. And there was a pretty clear price channel too, right there in Treasury bonds. In that price channel, started being violated. This was really, I'll kind of refer to this as the natural course for interest rates on that secular bear market in rates, which means secular bull market in bonds and also a bull market in equities because of the falling interest rates. And then something started happening about right here, and that's not mere coincidence. You see these spikes down below the channel, 1, 2, 3. These are the various rounds of quantitative easing. This is where the Fed, back then, it was almost considered the nuclear option. It was, unseen amounts of stimulus, both fiscal and monetary, with the Fed coming in with their zero interest rate policy and quantitative easing back when the financial crisis hit. That's 2008. Then you see these other rounds or bouts of quantitative easing, Fed just refusing to let the economy run its natural course. And recessions are a good thing. You need recessions to purge out the excesses. So the Fed's created the biggest bubble probably all time in history. I think that's unarguable. And then this was the all-out nuclear response when COVID hit, gross overreaction. And you can see, the artificial distortion and final really selling climax. If you're just a pure chartist, you turn off all the lines and levels and you see what is a pretty clear selling climax. Selling climaxes come at the end of a prolonged downtrend, and typically mark a lasting bottom, a reversal of that trend. So by that, and of course your primary well-defined downtrend line, and it's been broken, tells me that this isn't just a blip of inflation, but more of a trend change, and therefore it formulates my longer-term outlook. This and many other things, including the charts of the equity markets, and I think, well, again, I've said this many times, we'll be in for a much longer bear market than many out there. Probably very few, the pundits you see marching out on TV and in the media think and expect. But I'm not trying to be Dr. Gloom and Doom, and nor am I going to position short for the next 30 years and lock away the key, or the next 5 years, 10 years, whatever it takes. I will trade the markets as the charts dictate, but I will factor that in the macro, the longer term, bigger picture. So that's it. There it is in Treasury bonds. There's your breakout, and then again on the S&P 500, all that while what Treasury bonds yields, interest rates really is what we're looking at, the 30-year government bond, while those rates have been falling since that period of time, stocks have been going up. And so over time, I suspect we'll have rolling bull and bear markets, but more I believe we've just in such an early stage that it's almost unmeasurable at this point, but early stage secular bear market for equities. That's my longer term outlook. And again, you're not going to, you can't, you can position in it in different ways, and it might affect things that you do as far as investments and other things. But again, you're not going to short throw away the key on it, because the rallies are just too big. You're going to have bull markets within cyclical bull markets within a larger secular bear trend, just like these two previous bear markets that I mentioned, 51%, 57, they are called cyclical bear markets within a secular or a larger bull. All right, now what else does this chart tell me right here? This chart tells me that I have again, my views is that the bull market that started in 2009 went up until this point. I always referred to this as Ursa interruptus, my made-up Latin term for bear market interrupted by the Fed. By all accounts, there was a bear market priced in, and one did come if you count that 36% drop, but it was over before you blinked. The Fed didn't let nature take its course. In other words, the economic cycle run through. Recessions take time. Too many companies were bailed out. That keeps weak companies alive, weak consumers alive, and again, that's what creates bigger bubbles and then leads away for a bigger drop. Okay, so that's kind of my macro perspective. And I use the analogy of prescribed burns. I live in Florida. Some of you are out west, or some of you may be overseas, Spain, wherever you're dry, potential dry environments. Like Florida in our dry season, if they don't do the prescribed burns where the Forest Service comes in and burns down the undergrowth, what happens? It gets too much, builds up, and you have a lot of fuel. And then when you do get that lightning strike or the campfire that goes out of control and sets the undergrowth on fire, it burns down the 100-year oaks and everything with it, the whole forest. And so same thing out west where it's dry. And so that to me, those are recessions. You need to have those. And when you prevent those, again, if you prevent all fires and let the undergrowth build up too much, you're going to have a much bigger problem down the road. And that's the view I see with our bailout nation that we've been in for the last well over 10 years now. Anywho, so from a technical perspective, I'm just rambling fundamentals, right or wrong. What I can tell you definitively is this has been, for many years, I've shared it many times, one of my favorite indicators. I call it a 10. I rate it a 10 on a scale of 1 to 10 with a function of both effectiveness, that's very important on any indicator, but also simplicity. It's that simplicity, a single moving average on the monthly chart, 20-month period exponential moving average. It's the blue dashed line there. I also threw up for kicks and giggles, and I'll watch it, the 20-month simple in yellow. But you can see that line there, and it just does a phenomenal job of defining bull and bear trends. This is what I call your 401k indicator. When the S&P 500 is above the 20-month exponential moving average, you want to be long. It's a bull market. And also when you're above it, if you zoom in close, you can replicate on your chart, you want to buy pullbacks like right there, right there, right there. Because that's where in a bull trend it acts as support, and so usually you bounce, and that would have got you in long or added to longs after those corrections or covered shorts. Now once you finally take it out, and this is very important, this is a monthly chart, each candlestick is 1 month of trading history, so you only count or recognize how that candle closes at the end of the month. We're in March right now. Today's March 2nd. It's not going to be until the last day of the month that this candlestick that we're working on right now is finalized. But again, you can look at this, and nothing's perfect. You had a whipsaw again here when COVID hit, and again, you can say what you want, but you cannot argue that the Fed didn't go to the absolute extreme, both Fed and Washington D.C. with fiscal, and monetary stimulus. Fed does the monetary, government does the fiscal, and that again. Next month close out. Even if you took this darn indicator on face value and went short or got out of your longs every time it closed below, but then followed it religiously, you would have vastly outperformed the S&P 500. You would have gotten short right here. You would have reshorted right there on the back test of it. This is the last bear market, and you would have profited, not lost. You would have only, from the top there, you would have been out early of your longs, or if you're a swing trend trader, you would have capitalized on shorting most of the market, and then it told you to get back in here. And then again, most of these were monthly closes right on or above it. Very few whipsaws, and this time around what was different, that was a fourth quarter 2018 quick correction, bear market by the technical metrics, a drop over 20% in the NASDAQ 100 especially. But you can see here, this was we've been flirting at axis support for 4 months. And this is when we got short. We were short here. We were short actually right here. It's breakdown in the NASDAQ 100 swing trend shorting. bear market positions. And then there was our breakdown candle, a solid red candle, solid close below. And since then, again, we're looking at that blue dash line, back test, rejection, back test. Remember, look at the fat part, the body. Back test, rejection, back test, back test, back test, back test, back test. So we've been back testing it, and we're below it. That's the important thing. So until and unless you get a big green candle, a solid close, not anything we have to really zoom in. And, well, did we close above or below it? No. Once you're below it and you've clearly taken it out, then you want to see a solid close back above it. And remember, it's one of many indicators, one of many metrics. There's different time frames, but there's the bull market uptrend line, from 2009 lows. That was also taken out right here, back tested, and we're still below that as well. So there it is, kind of big picture stuff. This is pretty big resistance here, about 427 or so on SPY. You have, what else do you have here? You have a lot there. When you look down on the PPO down below, the PPO histogram is also a great trend indicator. When it crosses red, those are your corrections or bear markets. 23% drop there. There was a red, said, bearish crossover, and it covered that whole span, or most of, I should say, the 51% bear market back in 2000 to 2002. There's your Great Recession, Great Bear Market, 57% drop. Told you to be out of the market, right? 22% drop right there, 15% drop right there, 20% right there, and about a 36 when COVID hit, and here we are. So that indicator is still solidly red. You can see the histogram still clearly red. This is not a timing indicator. I can tell you that right now. By the time it turns green, the bottom will already have been in. However, you have to respect that as of now it's still red, and sometimes you do have bear market rallies, and we may have another leg down there. So that's another one to watch. And again, just confirming that as of now, by that, and then the most simple metric really for any bear market or any trend is looking at higher highs and higher lows. And here's the top of the market right there, the beginning of 2020, end of 2021, first leg down, reaction high. We've been zigzagging. So here's your reaction highs right here. There, and right there. So we've taken that one out. So give it, you got to give the market a little bit of props, put a little question mark there. However, that's a more significant reaction high. And if we take that out, then yeah, maybe we are going to new highs. Maybe not. Ultimately, you got to take that out to say the bear market's over. But those chip away at it. And okay, I've covered ad nauseum lately all over these 200-day moving averages, and we're still there right now. And they're going to fight. Markets will fight for these 200 days. We've been bouncing around them the last couple of days, but this is weakness. We took out the 200, we got rejected off the 200 exponential, the red line, the other day. And so far, this has been the big one here, the 200 simple. We've tested. We're testing it today. We went under it this morning a little, a hair above it now. So watch that. That's something. And again, the takeaway that I wanted to, and this is what I was talking about yesterday, is the fact that these long-term trend indicators are still bearish. On the weekly chart, what do we have here? You had big resistance. Remember T1, this is where we were short the markets for. These were bear market targets. This was my near-term first target, and it was a big level back then, and it still is, and that's where we got rejected. It's at 415.51. We hit it, we bounced as expected, then we broke down. Once we broke it, support once broken becomes resistance. Rallied back, rejected off that resistance. Rallied back, tried to take it out for a week, but also hit the bear market downtrend line, rejected. Rallied back, rejected. And so that's where we're at, guys. We're kind of, I've done this lately. Glass half full, absolutely. I'll give you that. Downtrend line, breakout, back test. Bulls want to see this. That's what the bulls should do. They should be stepping in and buying the 200s in the trend line. If they break it, we're going lower. So that's it. We're still at that key point, but I wanted to tell you that I think we've been backtesting quite a bit. I expected this bear market, backtesting the 20-month exponential moving average on the monthly. And I expected this bear market to play out a lot slower and different than previous ones. So it's hard to say if and when we're going to start that next leg down, but I suspect this would be the perfect time to do it. If we get a failure of these 200 days, the trend lines, and then it becomes clear to the masses that this whole breakout above the 200 days and the trend line was a false breakout. Now, we'll see. Let me go to QQQ real quick and get to a few trade ideas and trade updates. QQQ, there's our primary. I'm on the weekly time frame, and I know I'm jumping all over the place here. There was our primary bear market downtrend line. There's the 200 simple, 200 simple we're on right now, which on a weekly chart, if you're confused, a 40-week simple moving average on a weekly time frame is the same exact thing as a 200-day moving average on a daily, because there are 5 days in a week, so 5 times 40 equals 200. So there's your 200-day, and we've been testing it for the last 2 weeks. 200 days simple, and there's the trend line. So if we start to reverse, again, case can be made either way right now. I don't think it's a time to either go in heavy short or heavy long and throw away the key. And I will say, if anything, if you had to make one case or other, right now you have to buy it because you're back testing, you're at support. Again, it's TA 101. You cannot get aggressively short on a pullback to support. You can wait to short that support if it breaks, if it clearly gives way. But Trading 101 says you buy breakouts above resistance, which was right here, and or you buy pullbacks to support, which again we're at. So that's it. Now let me segue into some trade ideas that will kind of bring home the analysis, and I wanted to share this. Okay, I'm going to loop back. Salesforce today hitting that second target reminded me, to kind of go back. And I'll reference the previous post and all that, and give you links to those. And so this one, if you recall, if you're new to the site, I'll tell you. If you're not, you can go back and check the videos and the posts. Coming into the end of 2011, this is Salesforce, but the stock market looks almost the same, especially tech. I was short, made it very clear, and then right heading into the beginning of the year, told you I was starting to take some long hedges because a lot of the big market leaders look good. And then before the market ripped, I told you I covered all shorts and held on and even increased those longs. I was going pure play, pure play long, and I highlighted in the video covering that, also talking about shorts on the precious metals. That was January 11th. You can reference that video, and there were quite a few. And now the takeaway here, what I want to do is not just to revisit those. I don't always follow up on all trade ideas, win or lose. I just kind of move on to the next one. But the takeaway is, in the bigger picture of things, when and this is again something that I've just noticed over the years, when I'm clearly long or clearly bullish or clearly bearish on the market or a sector, and then all of a sudden, down the road, a few weeks, a few months later, most of my trades, the trade ideas that I shared, whether I took them personally or not, that most or all have hit my final targets. That's usually when that trend is over. And so if you recall, it was January 11th I first mentioned it. I've made an update to the post. I think I highlighted this candle here. That was January 5th. It was actually this first red. I knew it was a red candle early in the year. And so that's where it was highlighted, along with a lot of other positions. And here's my point. That was the max target. I took out here, and I'm fine with that. I took out, took book profits. In hindsight, I would have recycled back in on the 200. You can see the pullback to the 200. But here's the point. It hit resistance, and I've shorted this one today. Might not have rode it to the top, but rode up most of that. And I'm going short today because I give very, very good odds on a pullback, a tradable pullback. Tradable means you define that. To me, I get 5% plus on it, I'm happy. I'll zero in on targets later, but probably come back here. There's a massive old gap if it wants to backfill that, and there's a reaction high there. Oh, and I gave you the trend line. That's my target right now. That's what I drew in the video for you right there. I think we'll come back to this trend line, and that's good for I'm trying to measure it here for you. That's going to be good for about a 6% pullback trade. Okay. Is there a guarantee that Salesforce goes down for a minute? No, absolutely not. But I can tell you I have a negative divergence. I'm at big resistance. That target was not arbitrary. It was a big resistance here. It was support there. Once that support broke, that was it. That was all she wrote for Salesforce. Tried, rejected, tried, rejected, tried, rejected, and then boom, that's it. Okay, so it wasn't just Salesforce. I'm going to just rifle through some of the other ones in that particular video. Again, gold and silver were mentioned, pending sell signals on silver and gold, which came right after that. Pullbacks in the euro, those were spot on. So we got out of our longs there, shorted, made money there. And then the other stocks I gave you in that video, and told you were my favorites, and were Apple, most of the big fangs, but I highlighted three in particular that I was the individuals. I was long the Nasdaq 100, but then supplementing that with longs in Apple, Tesla, and Amazon, and an Alphabet too. Trying to recall. Anyways, mention them all as trade ideas. Apple, all of them, taking them here at the lows, and so you can see this is a big resist. Apple, we got the rally. There was a divergence. We were in a bear market, but we had positive divergence, and that was a catalyst for shifting, and I made it clear that I said tech would outperform the market. Big tech, the Nasdaq 100 would probably significantly outperform the S&P 500, which up until then has been the opposite. Big tech and the Nasdaq 100 led the way down, and the S&P outperformed. So that was spot on. And then look, here's the point: these things have come full circle. Apple rallied up, hit big resistance. That previous reaction high keeps it in a bear trend, right? Apple's been one of the strongest, or the strongest of the fangs, I believe, the big market leaders. But it's just a slower roll because it is a great company. But in a bear market, all companies go down. And what I just circled there are the major reaction highs. And there was one right there as well. And we never took that out. It got rejected on the temp. So that keeps the downtrend. Again, a series of higher highs, which I just circled, and lower lows, and it keeps it alive. Apple's traded through its 200s a few times, but they do act as pretty decent, especially over time. You go to weekly chart, turn off all the lines, it gets busy. You can see it does a pretty good job too of it's in a bull trend when above the blue line, the 40-week / 200-day. Simple and exponential moving averages. There, it took them out. It was a bear trend. That was a big drop. That was a bear market in Apple. Rejected, and finally recovered the 200s there, and then they act as support. You're in a bull trend. Took them out there. That was a big correction in Apple, bigger than the overall market. And so you can see that Apple has worked its way. It's been slicing through there a little bit, so they're not. But for the most part, this was it. We took out the 200s right there, tried to regain them there for a couple weeks, but couldn't, and failed. Rejected. Another breakout attempt. Look, we're not well below them now, but we are below both of them. So I just wanted to point that out. And more so, again, the takeaway from this is that a lot of these trades I was bullish on have hit their either preferred or really they're in some cases the max upside target I was looking for. So I think that's it for the bull market rally. I think there's a good chance that's it. I still told you maybe a marginal new high in the index. It's hard to say. We're at support now on the indexes again. But let me just wrap up with a few more of these trade ideas, and then I will get this video out to you. I'll cover the other trade ideas, the grains and natural gas and everything else in another update. What else did I cover there? So I had also Airbnb as a long trade idea, and that was right here. Pointed out to you there and told you the buy trigger would be on a break. We were right at this bullish falling wedge or the downtrend line right here, and I said this one would trigger a buy signal there. We got that buy signal. So here's my point, that we, if you took that one, it was good for as much as 58%. And You can see it had really good resistance here. It popped it for 2 days. This is comparable to that resistance on CRM or Salesforce I just showed you, but then failed it. So this is another one that, we identified in advance, spot on, bullish divergence, everything I like to see, all the reasons for going long and sharing these, but it's run its course, especially in a bear market. Now you got the 200s, you have the primary downtrend line, just like the market. So it's either going to, bulls want to see this, and that's still very much a possibility. But if we do this, that is very powerful, because something I've learned over the years, and I say this often, one of the most bearish developments I've ever noticed in technical analysis and trading is a failed bullish breakout. And the more clear it is, the more clear the breakout. In this case, both the stock markets and companies like Airbnb, you had a very well-defined bear market downtrend line. You had the key 200-day moving averages. They broke out. So on a scale 1 to 10, the breakout is a 10, absolutely. It's very good. Now you start failing the breakout. You start failing former resistance levels that now should act as support. And one by one, those are check marks. And once we get down there, once we're clearly below in both the stock market and stocks like Airbnb and others, and you're well below those trend lines, the breakout has failed. And then you get that, what I call point of recognition, where the bulls, and the bulls are the vast majority of people out there. I know the vast majority of you listening to my voice. It's just the way the financial markets are engineered. There are always a lot more longs. Most people don't short. They don't know how to short. Most mutual funds are long only. Majority of pension funds and things like that, long positions only. But once they realize the breakout has failed, two things happen. Those longs throw in the towel, their stops are hit, or they capitulate, or they're forced out by their broker with margin selling because they were chock full of longs on margin. And the sharks smell blood in the water, and the sharks are flexible traders like me, short sellers, whether they're institutions or individuals. And so again, those are things I'm looking for. But the takeaway is, right now, you can't write Airbnb off, but I can say that it has exceeded really my max estimated target for that one. There was a downtrend line there, and then that level there. All right, what else did we cover in there? So we had Align, ALGN, Align Technology. I believe this one was shared right here after the breakout, maybe. And again, another one that played out. Beautiful downtrend line. I mean, this was just... it's not hindsight. It was pointed out this is just there was so much evidence in the chart, so many reasons to be long in the beginning of the year for this rally, especially in tech. Beat down tech names like this. There was the positive divergence, and then boom, it broke out. And from the breakout point, this one rallied 83%. All right. Maybe it's the start of a new bull market, but here's what I'm watching. They've been fading it so far. That was a potential target, now former resistance, now support. And so what you want to watch on this one, ultimately it needs to take this trend line out. If it takes that uptrend line out, it's also taken out the 200 days, and this one will most likely resume a bear market. Let me glance up here. Amazon, I made it very clear, one of my favorites back here, long and strong at this point, even pre-breakout. That was when I first started taking as a hedge against the shorts, and then told you, remove those, covered the shorts, and pure playing this one long. And Amazon, one of the top companies out there, 32% rally, but look at what the stock did. This is a busy chart, I know, but yeah, breakout 1, breakout 2. Remember, it was at long-term support and everything else. Beautiful positive divergences. So again, we got the bear market rally. Is it the start of a new bull market? I don't think so. Time will tell. But there's a potential downtrend line. I think we hit that already in the pre-market session. I don't think that's there. And then I talked about this one recently. You got smacked down hard. This thing rallied right into the intersecting 200-day simple and exponential moving averages, and it put in this island reversal top. That's a candlestick separated by a gap on both sides. And island reversals are lasting. They're turning points. If it's island reversal top, then that is the end of a rally and start of a new downtrend. And either way, it certainly has been. And so there's one so far, had a bear market rally, and they faded that. It's dropped from that high right there. It's already dropped 19%, and it's below its 200 days. And you go back to a weekly chart, and this is what a bear market looks like, guys. This is, here's your 200 days, bull market, you have corrections, you get below them. But when you're above them, support, and then broken. And once you break the 200s, then they act as resistance. And again, on a weekly, I'm looking at the 40-week moving averages, same thing, boom, boom, boom. All right. And Amazon, as much as it's down, it's a great company. Here's my bull market uptrend line. This charting program, one of the things I hate about it when you have stock splits, they don't adjust the lines. So these are old lines, and you had to split. But I did update the. Here, I'll just turn everything off and show it to you. This is, here's your primary bull market uptrend line since the stock came public back here in '97. And it's pretty darn well defined. 1, 2, 3, 4, 5, 6, 7 reactions, and then boom, it broke down right here, back tested, and it's moving lower. So this is a stock that appears to be in a bear market, and with no signs or evidence that the bear market's over yet. When will that change? Well, maybe if it takes out the 40 weeks by a good margin, regains that uptrend line that broke, and so forth and so on. All right. Again, takeaway is it's not actionable right now. I have no position in Amazon, and but I just wanted to show you the price action and the fact that, hey, these things played out. Just like we went long. Remember, we were long here, here, here. Every pullback to that level, because that was a long-term support, and the reasons for that positive divergence. So we gamed that bounce, told you sold it there, recycled back in there, and it failed at the 200s again. So these are bear market rallies, right? That's what I'm trying to point out here. A few more, and some of these might have, some might be trade ideas actionable. A CRM certainly was. I told you. I think that's a fade of today's rally into T2. DDOG, Datadog. I highlighted this one's bullish and long, positive divergence. That was in the beginning of January. I don't know exactly what would have been. Oh, it was in the same video on the 11th, which was right here. There's the candlestick. So we got about if you took it, 29, almost 30% rally, and look where that rally ended right here, smacked into the 200-day moving averages, rejected. So you still have the breakout above the trend line, and again, bulls want to see this, maybe a back test, and that. Bears want to see a failure back below that the downtrend line right there, and if we take out the previous lows, that's going to happen. So again, it's a matter of, and a way I look at this from another perspective, if you take this divergence line here, the positive divergence, and the downtrend line, it gives you this wedge type pattern. The measured target for a falling wedge pattern is the widest part of the wedge from where it breaks out, and you add that on, and that would have given us a target up there. But in a bear market, quite often you're going to fall shy of bullish targets. That's another trading thing that I've learned over the years. If I'm shorting a stock in a primary uptrend, then I will aim for the shallower targets, because quite often the measured targets aren't reached. But in a bear market, the measured targets are often reached and then some on short trades, but they fall shy on long trades. So there it is. D-Dog played out, but again, you took it, you got the juice. Even if it goes up from here, you got out there, book profits, move on to the next one, wait for the charts to set up, and I'm working. I'll try to get you some trade ideas, but remember, we're in a sideways market right now, mostly sideways, and so I've been throwing out long and trade ideas like Intel long yesterday, but then Tesla short, and I'll continue to do that. And another takeaway from this video, if you haven't noticed by now, if you took these individual trade ideas, you vastly outperform the stock market. I showed you when I do these videos, they're my top picks, and I made it clear in the beginning of the year. I told you I thought it'd be a stock pickers market where you could outperform the indexes, and that's certainly been the case. What else I did? ENPH I can see was on there. Let me see what that one did. And phase, I don't think it did anything. I think that was maybe a long there to support. It's got divergence. This one will probably pop if the market holds up. It's below support now, but it's pretty strong positive divergence. Maybe if it has earnings coming up, I don't know. I haven't followed it. You can check that yourself. Google, which is Alphabet. Again, beginning of the year, point out these trading ranges. They popped, rallied up. So that one was good for from those that January 11th video, 22% or so. And you can see where so far you have this trend line. I need to tighten that trend line. I'm going to clean that trend line up. What I'm doing is I just pulled it down. I had it a little higher. There's the high, initial high. You had these reactions and now this one. And that also coincided with a rally into the 200-day moving averages. We popped them by a slight margin and hard rejection. This is bear market stuff. You see these hard rejections, and there's still some stocks that are rallying, some that are just recently breaking. I like Salesforce today, but it rallied into resistance. So again, and I know I'm repeating myself, the common theme here is most, if not all, of these stocks that were highlighted as bullish back then have played out to what I believe to be is at or very near the full measured target of what the technicals were indicating they would bounce to. I think that's it. I had Marvel. I mean, there's a few others in there. This one was highlighted here. And where was that? January 11th back here. So maybe on a breakout above 30. I'm trying to, yeah, it would have been right about here. So that one was good for about a 31% rally. And look at that, smacked into the 200-day moving averages. And so far, they are containing it. It's acting as resistance. So bulls want to see it, this stock break above there and run. Bears could short here because they're at resistance for a fade, a short at resistance. And, maybe we get a back test later on. But yeah, I'm seeing. Here's what I'm trying to say too. A few weeks ago, I was adamant that the risk reward here was favorable to being short, not long. And we've, if you did that, whether you did it as a, you added back swing trend short positions or you just wanted to fade the rally, you made some good money. The Nasdaq 100's already dropped about 8%. But what I'm telling you now, I believe that the risk reward is still, lately I've been, and talking about it, and I will recognize it that, hey, can't go crazy short yet because we have those 200-day moving averages and trend lines. But I do believe at this point the risk reward, it is not as clearly favorable as being short as it was back here, but I think it is still, especially for a trend or position trader, I believe that the risk reward, despite the fact we're at support, is skewed to the downside because of my longer term outlook and everything else I'm talking about here. A lot of these stocks having pretty much run the course of what the technicals was saying or were implying that they would do in the beginning of the year. All right. I gave you a few shorts too, but such in that video, I always try to balance. Like KHC, for example, was covered in that video right here on the 11th, which was this candle right here. Told you it would be a short entry on the break of that trend line. I updated this one when it happened that day. It wasn't a big gap down that wouldn't have provided an objective entry. The stock opened there, triggered the sell signal, and then just kept moving lower throughout the day. So there's an example of in my theme too, the bear market is for the rest of us. I said let's be long tech and all the beat down big names, but then I'm starting to pick on those stocks that didn't get the memo that we're in a bear market, particularly the Dow and S&P components, and this was one of them, and there's been others, and that's what's working. So again, if you have the time and inclination or skill sets to actively trade a portfolio of individual stocks, going long the most bullish and short the most bearish, you should vastly outperform the market. And especially in a sideways market, that's the only way you're going to make money. You have to provide seek that alpha. Alpha is trying to produce returns above the market, and this is the way to do it. Now, if you shorted KHC, you can see it's traded through the 200 several times. We're below there, but we're also below support. And a lot of these, I go to the long-term charts, and the long-term charts are telling me, well, I don't have much of a read on this one. Apologies, that's not the one I should have went to, but other stocks like especially Apple. When Apple dies, truly dies, that's when the market dies. When does Apple die? Well, I have a long-term trend line that comes off the 2003 lows right here. That is this trend line here, and we're flirting with it now. And Apple, like I said, when it clearly starts moving below these the 40-week / 200-day moving averages, that's when the bear market will likely get underway. And Apple, you can see it here, has a lot of downside in my opinion. I think before all is said and done, this one and the market are going quite a bit lower. All right, this video's gone on long enough. I think I made the gist of what I was trying to get out there clear, that hey, you know, there's some crosswinds right now, or like I said, a case could be made to be, you know, stepping in and buying here because of some support levels. But you know, sometimes I will, you know, I like to look at everything, and my job is to provide you with analysis, and not just one-sided analysis. I'm not only going to, you know, sit there and make the case for which way I think something's going. If I see contradicting evidence, number one, it's going to tell me to slow my roll, maybe not be so aggressively long or so aggressively short something, but also, you know, it's you need to recognize those things out there, and right now those are, you know, support levels I'm recognizing and watching, but also waiting to see those levels one by one get taken out, one market leading stock and or sector after another rolling over. And the charts are playing out as I thought they would, you know, so far this year. If you remember, I do my sector analysis from time to time, and I told you things like XLV, which was one of, if not the strongest sector in the market. It really didn't get the memo. This is when the bear market started it was back in November of 2021 for the NASDAQ here, but yet the healthcare stocks continued to make all-time highs until just recently. And then I pointed out this trading range here and said you've had two, now then recently three breakouts above there, which all had two things in common. One, they had negative divergence, which told me those breakouts would likely fail. Breakouts that occur to all-time high or any highs with negative divergence have a much, much higher rate of failing, and the previous ones did. And I said when you do re-enter the price channel after a false breakout, or even when you rally to the top of the channel and get rejected, your next stop is often the bottom of the channel. Bottom there, I think we had two false breaks on the bottom, and look, we're almost to the bottom again. So that the pattern's playing out, and this is also a, you know, a way to, you know, trade the market, outperform the market. You know, within the last, so far this year, you should have been, up until recently, long tech, short healthcare, short, you know, some of these stocks that were trading recently at all-time highs that had clearly bearish charts, such as, you know, KHC. All right, I will wrap it up here and get the video out to you guys. And like I said, if I can dig up that one from yesterday, maybe I'll post a link below. But it's a lot of the same. I just spent a little more time going over the long-term charts, kind of painting out the big picture. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.